All right, over the last 2 days, we got what we were looking for early this week. Now what? Now what do we expect to see going forward into the end of this week and beyond? Has that proverbial train left the station now, or do we still need to see some signs? So I'm going to break that down, show you some charts, show you some levels to keep an eye on, to know exactly when it's time to, as I mentioned in the video later, be more directionally bullish in your active trading portfolio. So we'll break that down from a technical perspective. We'll break down what's driving the price action and why this pullback might be about as bullish of a pullback as you can get. And then where we might be able to find a pocket of strength here. We've been kind of back and forth in this area, and today there's an opportunity for a trade to the upside. So let's go ahead and get started. Today is Wednesday, June the 12th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator on the Russell there. Because I'm actually doing a double take on this segment of the video because the first segment didn't record correctly. But going back to the S&P 500, we're getting the pullback that we had been expecting, right? We had talked about the near-term line getting below 50 relatively quickly, and similar to what we saw over here on the initials, after the initial surge off of that intermediate low, that extreme intermediate low, that initial surge up, usually we get a pretty quick pullback on the near-term line, and we did here. Not to the same, that was kind of a one-day decline. We did gap down on that day and then rallied up. But we had more of a one-day decline there. This is spread out over a couple days, but today's range, very, very small, less than 14-point range with no gap. Or at least the gap was filled on a 34.5-point average range. So, and that average isn't very high either. So very, very small range, but enough to bring the near-term line down. This smaller range helped bring the near-term line. It would have been a little bit better had we gone down a little bit more. Like the more ideal scenario would have brought us down about 2840-ish, where that top of the Fibonacci retracement zone is. So that would have been the more ideal scenario in a pullback. Again, we don't like the abnormal moves, right? Abnormal moves, even if they're in the impulse direction, if they're too long, we've seen they produce pretty big consolidations, uncomfortable consolidations. Well, if the consolidations are abnormal as well, in this case, in the case of consolidations, they're abnormal in the fact they don't go down enough, right? So if we don't get enough of a consolidation, then we end up, again, I always compare it to like breathing patterns, right? So if you take a nice, good, deep breath in and all you get is a shallow exhale out, and then you take another deep breath in, it's hard to maintain deep breaths with really quick and shallow exhales over and over. You just run out of air. You eventually run out of air, and you have an exhale that is a lot more than normal. So that's, we get a little bit of a pullback. It would have been nice to get a little bit more. We might still get another day or two of weakness, but the near-term line, hopefully not enough to get it too far down. We'd like to keep that near-term line up above 20. Maybe, it can dip its toe like this under 20, right where my cursor is here, but, not too far. We don't want it to go too far down. And you're probably, if we do get any more weakness, we're probably not going to hit the 2840 now. Maybe on an intraday basis we would, depending upon the news. But we're probably going to, if we do get any more weakness, touch down to this, 2866 level. So drop down, maybe set a low point there and then bounce off of that. That would be the more plausible scenario. Not enough of a pullback to get the near-term line to drop. And if we hit that on an intraday basis and bounce, we might actually get the near-term line to pop up a little bit. So, but we pretty much have had the near-term pullback that we were looking for, and now we look for the bounce higher. And if the near-term line bounces higher and gets back above 50, we expect 7 to 12 days. That's the normal range. Of course, not everything's 100%, and you even though you have expectations, when it doesn't meet expectations, that's when things change, right? That's when your postures change and all of that. So we'll keep our eyes on that. The Dow looks very similar, above the moving average, even though the moving average is still falling. So you have dark green shading, but we don't have the dark green line yet. So we kind of need that. to really be bullish here. And then you notice the NASDAQ is also above its moving average. Its intermediate line just barely got above 50, so we finally got dark green shading, but we don't have the green line, so the train hasn't left the station yet. But you got the near-term line below 50, and then finally the Russell's been lagging. It's been down here below its moving average. Its intermediate line's not above 50, or even close, really, for that matter. So, until we can get small caps to really break out and get up above this 23 level, which also happens to be where the moving average is, and get going, it's going to be hard for the train to leave the station. We're bullish. The engine's running, right? We expect that the intermediate line will get above 90 and then, have a couple month rally through August, maybe even in mid-September, before we get the green line to start coming back below 50. That doesn't mean that we might not have a couple weak bearish moves here, but we are at the beginnings of what could be a multi-month intermediate run. But until small caps lead that way, the train hasn't yet left the station yet, and headed out into the countryside, so to speak. As always, before we look at some more charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. That notifies you when our videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you like the video. Number two, you want us to do it again tomorrow. So quick way to give us feedback. You can do that right now while you're watching. Also, comment down below. What did you get out of the video today? We'd love to hear that. Join our Daily Market Outlook email list. There's a link popping out right there on the screen. Very easy way to subscribe to our emails. Follow me on Twitter for more content in between videos from day to day, and join our Market Outlook community that we created on Facebook. All right, we also invite you to subscribe to our website at marketscholars.com. If you're watching our video on our blog, go up to the top right corner and click on that subscribe image here. A very easy way to do it. You can do it for free. That gives you the ability to participate in our Market Outlook forums on our website with other market scholars. Of course, premium subscribers get access to our classes. All of our classes, there's a schedule coming up here. Also, we invite you to engage with us on social media, on Twitter and Facebook. The more that you do, not just look at our stuff, but actually like and retweet, the more that the Twitter and Facebook will continue to push you our materials. So we make it really easy for you to engage with us. Just hit this heart right here. That opens up that new window and likes today's Market Outlook tweet. Click on this image, takes you to your Facebook page. You can like the post there. Again, you can do that right now even while you're watching. All right, back to the charts. Let's take a look now at what's going on here on the long-term charts here, and we can see the small range, a little bit of a long upper shadow we're getting. But remember, we anticipated a near-term pullback early this week when we did our video on Friday. It took a day, but we got it on Tuesday and Wednesday, and now it wouldn't be surprising if we don't fill in the rest of that candle here by the end of the week, tomorrow and Friday. So it is a small candle, but that's typical. When you get a big range, when you move down below the 200-day moving average, you've had the big move higher. You can see both of these where we got down to the 200 or maybe even below it a little bit. Then you bounce right back up the next week. The week after that, it's not going to be the same range, right? We kind of peter out there. You can see some other instances over there. So then wouldn't be surprising, but if you look at the Heikin-Ashi candles, that's a very bullish candle, and that's a very big range too. So that means the midpoint's going to be right around probably 2850-ish, 52-ish next week. On the S&P, we're trading at 2879 right now. We might even go up higher from there by the end of the week. So very good chance that next week's candle is going to be pretty bullish as well. Again, barring any late declines that we might have this week. Let's take a look at the 3 green arrow charts, and you can see 3 green arrows, nice, but we don't have a green line, right? So we're not, the engine's running, right? We're putting coal in the engine, however you want to take that metaphor. We just haven't left the station yet. We're still parked inside the station, but we're getting really ready to go here. And so if you look now at the 2-line versions of this, this one. Nope, this one. The 2-line versions, you can see the MACD is above 0. It's above its moving average. Stochastics is above 80. It's above its moving average. So we're bullish, and the moving averages are rising. So we're above the 8-day moving average still, even with this little pullback. The 8s cross the 30, the 17s getting close and may cross it either tomorrow or the day after that, which are all bullish signs of of trend reversal, of being bearish back to bullish again. So, like I said, there's more confirmation that we're headed in the right direction. We're headed towards the right direction, even if we're not in that direction quite yet. You can see how small the range is when you look at it on the intraday chart. Very, very small compared to yesterday's, but at the low end of yesterday's range. In fact, we kind of closed right at yesterday's low point. We filled in, if we didn't finish filling in that gap yesterday, we still finished filling in there. It would have been ideal again to come back down towards that 38% Fibonacci retracement, which, as you can see on this chart, if I were to go here, let me just make sure I get snap these lines here. But if I come over here, actually I think, oops, dang it, I don't know what I just did there. But if you go from low to high here, then you can see that's where the 38% is, right? To that 2840 area. So we can pull down in there, and we would have filled in this gap, right? So we still haven't filled in that gap yet. All the other gaps we haven't. This is kind of a runaway gap. So obviously we're not going to fill that one in. If we do, it's going to be after much more protracted decline. Runaway gaps are the ones that start the moves. They don't get filled in. It's the normal moves here while we're rising that do get filled in. So we've had the pullback. It would have been ideal to come back a little bit more, but we didn't, at least not yet. And so we'll see if just filling in this one was enough before we now hit that base level around 288, bounce off of this, and get back up through 290 and get to really about 292.5, as you see here on the Bollinger Bands chart. That's really the area. That's the value, the top end of this value area. 292.47 is the top end of that value area. So getting through that 292.5 will be significantly bullish for the S&P, at least SPY. All right, let's take a look at, as I showed you, the range was really small today. And let's look at the volume also for SPY. So the range below half, less than half of what the average is. And that's not really a big average. Look at the volume down at 47 million as well. Incidentally, that's pretty bullish. That's a normal bullish. If that's what our pullbacks look like, great. Right? We just don't want the pullbacks to be the big, huge declines. But you can see bringing both lines down is bullish, and again, once they get down to low levels, they can stay down for a long time, and getting this back below 1% is also going to be a bullish sign. So that's about as bullish of a pullback as you can get. The only thing we're not getting, and it's not surprising, is we're not getting a decline in volatility, but we're also not getting a bounce in volatility either. And remember, the train leaves the station when we drop below 90%. So we're not quite there yet, and we might still bounce up towards the top end of this range, maybe even a little bit closer to 1. But that's not going to be necessarily bearish as we saw over here. That's not going to be the most bearish thing. But more than likely, if we do come up a little bit, you can see we haven't even during these last couple of days. That's about as high as we got right here. So that's probably our top end of the range right now for volatility. And getting down below even the midpoint, this 92.5%, getting below that midpoint will be kind of that first stage of the train leaving, kind of getting in that first car out the door, and then getting below 90% will get the rest of the train going. So to summarize, before we look at what's driving the action today in our trade example, to summarize our market outlook from a technical perspective, we've been bullish. We were expecting a quick short-term pullback. Over the last couple of days, we've got it. And now, maybe even a short-term bounce back up into the end of the week. And then, like I said, once you get through 292.5, volatility drops below that 90% mark, then away we go at that point. Away we go. So that might happen early next week. Probably will take about another week of ups and downs in this area before we actually do that, is what I would expect. So we might, have a little bounce in the end of the week, maybe some weakness, ups and downs over the next week, week and a half. And then get through that June expiration, and then you again those levels that we watch for, breaking through those. Then it's a way to then we're away from that point. And as I mentioned, with the intermediate line crossing up above 50, and the expectation that we'll get up into the upper reversal zone and stay up there, We're looking at a 1 to 3 month typical time frame of an intermediate rally, and that puts us into August, into potentially the end of August through the beginning of September before we see some weakness. At least more weakness, more than just the typical short-term weakness. So what do you think about that assessment? Do you agree or disagree? As always, I want to see your vote. Click that link right there. It opens up a poll, and then you can vote either agree or disagree. If you click disagree, which is perfectly fine, scroll to the comment section and let me know what you're seeing that would suggest otherwise from what we just came up with here through our routine. All right, now let's take a look at what's driving the price action today. So we'll take a look at the asset comparison chart here, pull up our asset class watch list over here on the left. You can see agricultural commodities doing really well today. They've been bouncing up from lower levels. You can see them right here in this kind of bluish level and where they're at over the last couple of weeks. Gold, interestingly enough, gold and emerging markets are doing really well. That's not surprising when the dollar is down, as it has been over the last 2 weeks. This is a little bit of a surprise. So the weakness that we've seen in equities has been, we haven't had the same drop, but you can see the decline that we've had in crude oil, kind of a double bottom looking like it's trying to form here, has weighed on stocks over the last couple of days, really since early Monday morning. That's been something that's weighed down. And if I were to go back, let's go over now 4 weeks here on the S&P on this time frame. So we'll go out to June. We'll do, let's see, 1, 2, 3, 4 weeks, and we'll do a 10-minute chart. So here's the last 4 weeks. You can see the agricultural commodities have been doing well. Again, they're the kind of a proxy for the expectations of trade issues with China. They're the ones that have suffered the most during those trade arguments that we've had, and emerging markets obviously the same as well. They're kind of matching the S&P here. But you can see over the last 4 weeks, bonds, foreign bonds, that's that BWX, TLT long-term treasuries, gold is up here. So we've had a little bit of a risk-off pattern here. What's interesting is from this point right here on crude oil, from late Monday on the 3rd, S&P's up. It's doing actually really nicely from that point. But crude oil, you can see, is not up. In fact, it's actually down a few percentage points from where my cursor is. So that's a little bit of a break. You can see all the other risk-off classes are actually kind of holding up too. Small cap stocks also lagging behind during this run. So this little rally we've had lately is not really the most risk-on rally. So again, we've got the seeds of bullishness. We don't quite have that strength there, and that divergence in crude oil. If you take a look at a chart here, let's go like a daily chart, and we'll take a look at crude oil there, and then we'll take a look at a comparison with S&P there, and we'll look at a comparison. Let's get rid of all these and look at a comparison with crude oil here. We'll just do a line chart on crude oil. Then you can see, okay, not surprising, we had a little bit of a divergence there. Crude oil bounced up before stocks bounced up, and then as stocks were rallying, crude oil pulled back, and then they both were out. So a little bit of divergence here that rectified itself. Then they really both declined down to that Christmas Eve low. They both peaked here on October the 3rd. They both bottomed, and then we rallied, and we rallied, and we rallied, and then crude oil peaked right here on April the 22nd, and we stayed bullish for a little bit longer until May 3rd. Crude oil had already dropped by then, and then you can see we really started to decline, and we formed lower highs on the S&P and crude oil on this little bounce around May expiration. Then we went further down, and we got a low here on the S&P and a similar low on crude. And then from that day, you can see crude oil has continued down, and not the S&P. The S&P is a lot further up. So a little bit of a divergence there, that we're not seeing the same moves in both risk asset classes. And that's even with, if I were to change this now, the dollar. You can see the dollar index. While the dollar rises, crude oil came down. And then when the dollar peaked here, crude oil bottomed and rallied. But interestingly enough, from this time from the time that we hit this low point in crude to the time that we hit the high, the dollar is actually higher at that point. So the dollar rallied at the same time crude oil rallied, and then as crude oil's been dropping, the dollar's been dropping. Now it's a little bit of a bounce today, making somewhat of a return move back up to this old trend line that it had. So I wouldn't necessarily say we're out of the woods. We have a couple Harami patterns here, and then a little bit of a bounce. You can see what it looks like on the Heikin Ashi. So a little bit of a transition candle. So I wouldn't be surprised if we get a few days rallying up towards this old resistance trend line and this old low point over in this area. You can see what it looks like on the regular candle. So up into this 97, maybe 97 to 97 and a quarter area, the dollar can rally up to that point before finding some resistance and rolling over. And maybe that's what will take for crude oil to really catch a bid and move higher here, because it's hard for it to really get going to the upside without a decline. Get going to the upside here without at least a decline in the dollar to get it going. You can see that's kind of what started it here. You had this decline in the dollar, and then every time you had a little bit of a drop, you had another surge in crude, and then you had this drop here, and you had another surge in crude. So even though we were getting, we weren't getting lower highs and lower lows on the dollar, that accompanied the higher highs and the higher lows we're getting on crude. You can see how the crude surges every time the dollar drops. So you had a little bit of a drop here, and you had a move higher in crude at that point, and then but this is the move here where a drop in the dollar did not go with a move higher in crude. And then now this drop in the dollar, same thing, has not associated with a rise in crude. So crude's depressed here a little bit, and it's not able to really get going. The other major market that's been kind of moving is the 10-year yield, and you can see it's been very depressed. We saw all the clusters that the 10-year index has had, and it's we've seen this before, getting multiple clusters, and especially on the weekly chart when you get multiple clusters. At in this case we got 1, 2, 3, 4, 5 in a row. That's not too often we get so many weekly clusters in a row on there. You can see there's a couple times we might get a couple, and maybe spread them out a little bit, but we got 5 back to back to back to back. So significant decline. Not quite on the monthly chart because the intermediate line is not down below 50, but you can even see the intermediate line here. That we got the bearish pattern forming with the red line and the dark pink shading, the intermediate line dropping below 50 on yield. So again, not a dollar bullish environment. Even if we get a short-term bounce in yield, say up to this 2.4% area, that would not be a dollar bullish environment. In fact, it would be enough maybe to get these short-term lines up towards and maybe a little bit above 50, similar to like this move here, and then continuing the trend, which right now is to the downside. I don't know how much more downside there is. If we have too much more downside and the Fed ends up doing more of its rate cut, if this ends up being more than just a couple, 1 maybe 2 rate cuts, then that's going to lead us to a bear market, or at least be a reflection of being in the macro environment that would put us in a bear market. As of right now, the futures market's pricing in these 2 cuts. So there's an 98% chance we'll get one by the end of the year, and we have an 85% chance that we'll get a second one by the end of the year. But the third one, you can see the odds of us getting a third one are not very high. They're relatively high, but you would have to add on 34, you'd have 48, 49, 50% there. So we're about a 50-50 coin flip for a third one by December. And if I go all the way out to April here, and you can even see here, we're looking at 31, 32, 33% odds of a third rate. So that we're talking about a 66% chance of a third rate cut, by next April. So that's not very high odds. I mean, that's definitely not in the 80% range. So the market's looking at one probably in July, if not September, but probably into a pretty decent chance, 85% chance we'll get in July. Then a second one, if not September, then by December. And then I think the market would be kind of in a wait and see mode, because you remember to keep in mind about about the last rate hike that we got in December right here. The market showed us, the whole risk market showed us that we didn't need that the markets didn't think we needed that, and the bond market also saying that we didn't need that, and because since then everything has been on the declines. So this first rate cut will essentially be just reversing a move that the markets think we didn't need in the first place. The second rate cut would be going beyond that, and seeing what we need, and then we'll see by then this economic data point here. This, you can see inflation expectations are really low right now. If they continue to drop down, then we're going to be in a protracted rate cut environment. Otherwise, you can see here, we started raising rates. We stopped raising rates here in June of 06 when we were in this area, and then by September of 07 we had cut rates for the first time. So inflation expectations had dropped, but not nearly to the same extent that we're seeing here right now. That's a pretty decent drop since the last time the Fed raised interest rates. Well, let's take a quick look at the sector rotation. You can see over the last 4 weeks, again, same 4-week period, that energy has been, crude oil has been down, energy stocks have been struggling, communication services stocks have been struggling. These are your FANG, at least Facebook, Netflix, those stocks holding back, as well as other telecom stocks and media companies to be in this area too. You can see industrials with some weakness in the last couple of days with merger news, but you can see that the two biggest winners we've had over this 4-week period has been materials as well as healthcare. So these two have been kind of beaten up previously. If I were to go back out, like say 6 months, you can see healthcare has been one of the beaten up areas. Materials has been one of the beaten up areas. Staples as well, and you can see those two. Energy is still not quite. Energy right now has probably got the most value relative to all the other sectors. If you take a look at the 12 grid, here we go, for all the main sectors, you can see today the biggest loser on the day today, obviously, with the drop in crude oil. But if you take a look at it's the only one that's below. I guess communication services too. But this one's a lot further below and much steeper decline, down 7%, where communication services is flat for the 3-month period. So it's got the biggest value. All the rest of these has some positive numbers and are even above, at worst, falling moving averages. Some of these are above rising moving averages. Real estate, healthcare, staples, utilities are all doing pretty well, and those are all safe haven sector, so keep that in mind. And materials, you can see the first kind of cyclical sector to really break out and give you a green line and a move and a dark green shading. All the rest of them are giving all these other cyclical areas, like the market as a whole, have the dark green shading but don't have the green lines yet on their moving averages, and the energy is not even close. It does have a green shading, just not dark green shading. It's the only one that's not, I guess communication services too is not above 50 yet, but obviously also not anywhere close to having to trading above what would be a rising moving average. So they get the green line and the dark green shading with the intermediate line rising up above 50. One quick thing to note from the crude oil before I look at the trade idea here too, kind of backtrack a little bit. Keep in mind that as we are pulling back here on the futures contract, and we are kind of double bottoming here, keep in mind that the RSI is diverging and is at extreme lows, and the CCI is also diverging. So the CCI had its biggest drop over here, and then now obviously getting the lower lows and the higher lows. So we are in the process of forming a divergent low point, a lower low associated with higher lows on these oscillators. If I were to also look at the regular MACD and stochastics on these, let's go to the 2-line version of those charts and go to crude oil. You can see kind of the same thing, right? These last little leg lower right now would be a divergent low point, a lower low, at least a lower closing low, corresponding to higher lows on these blue lines themselves. All right, let's go back to that strong healthcare sector. One stock that's getting a new 52-week high here is Merck. Back to we've kind of been up and down in this sector, but this is one of the stocks that's been doing really well. And you can see it's got a strong bullish posture. It's got a dark green shading, dark green line. You take a look at its three green arrow charts, and you can see obviously you got a bullish pattern developing there. We're still on that initial surge, up higher, easily above the 17-day moving averages, rising. Buyers are in control. You take a look at the Bollinger Bands. Merck is one of the few stocks that is up above its value area, so it kind of just broke out of its value area. So again, support down here now at about 82, and then a lot of good room to run to the upside as long as obviously the market posture as a whole stays bullish. Take a look at the DMI version. The DMI charts easily above 25, easily below 20. So the ADX is about to break up above 20 itself. In fact, if you take a look at the trend strength for Merck, it's got a really strong posture, or a strong trend on the weekly chart. If you look at it on the daily chart, it's just now getting, it's not quite there, it's not above 5 yet, but it's just now getting to the point where we might get another good strong run on the daily chart. And again, if I do sell a short put on this, sell the 82.5, buy the 80, I don't need it to make a big run to the upside. I just need it to stay up. Remember, 82 is where that support is, so right where the short strike price would be. And in this case, if I, right now we're getting more than 60 cents. If I set my stop limit to say fill me in at 60, considering how tight the spreads are, then that would allow me a higher probability of success. Lower credit, but not too low, right? Because too low, 58 cents is 30%, so we don't want to go below that. But if we can get around 58 to 60 cents, we get a high probability. This requires the stock to bounce. So if the stock pulls back a little bit to 82 first, we don't get filled in until that credit drops down to the level where we have a decent probability for the risk that we're taking on this trade. All right, so that wraps us up for today. As always, thank you very much for watching. Now I want to hear from you. Let's keep this conversation going in our Market Scholars forums, our Market Outlook forum specifically. Use that link right there. It takes you straight there. Remember, you have to subscribe to our site, but you can do that really easily for free. I showed you how earlier. Also comment on, remember to hit the thumbs up icon down below, comment on the video, subscribe to our YouTube channel if you haven't done so already. Thank you very, very much for watching. Have a great rest of your evening, everybody, and we'll see you all next time.